Hi everyone, it's PJ Patterson for a quick position update. Actually, it probably won't be quick, but a position update. Today is the 3rd of September, third day of spring. Happy spring. It's going to be a little rainy in Sydney this weekend, apparently, so boo-hoo for that. Let me grab Interactive Brokers and drag this over here so I can walk through what we've got in the portfolio at the moment. So right now there's 53 positions currently in the portfolio, and I just wanted to walk through sort of what's going on with each of these so that you can continue to get an understanding of how we're invested, why we're invested that way, and what I'm anticipating. So from the last market update, nothing's really changed. Still expecting inflationary environment. We're in quad 3 at the moment in the US. Very likely to be pivoting into a quad 2 environment, interestingly enough. The data continues to improve, and I've been saying that all along. The economic expansion continues to improve or recovery, I guess is probably a better word to use. We're not really expanding, we're recovering from our previous, where we were previously in the U.S. And so it's very likely we're going to see improved economic conditions there. But I'll update that in more depth in my market update. So just quickly, I thought I'd run through each of these. I'm not going to go into great detail on what they are, but I will highlight sort of asset classes and some of the individual stock holdings that we've got. For those of you that are new clients or just coming on board or have just come on board, what you're going to find is that I am typically using mostly ETFs, exchange traded funds. If you're not sure what that is, I think I've done a video on that or a podcast on that. You can click on the link in this email to jump to the podcasts and listen to that, or you can just Google exchange traded funds and you'll get a definition probably on Investopedia. Very much like managed funds, but they're actively traded. Anyway, I use those because they give me the ability to get macro exposures to either the macro environment, so like say tech or industrials or oil or energy, that sort of thing. And it gives me instant diversification as well across that particular sector. So as in the case of XLE, which I'll talk about briefly, XLE is the energy ETF, and it holds, I think, about 30 energy companies inside of the ETF. And I've pulled out some of the top companies to actually own directly, which are all listed right here. This is the energy, basically the energy portfolio that we've got on. And so that's basically what I'm doing with the ETFs. But anyway, all pretty much ETFs. I'll run through those now. And of course, we've got anything here that says, has a little notification next to it like this, ASX, just indicates the exchange that these are actually listed on. So the ones that do not have a little notification next to them are on the U.S. stock exchange. Anything with ASX is ASX, and I rarely, if ever, would own anything on other exchanges, but we do have the ability to do that in Interactive Brokers, but it's unlikely. Most of the time you're going to see me owning either on the U.S. stock exchange or on the Australian stock exchange. Okay, having said that, let's rip into it. So here are all of our Aussie positions at the moment, and what this table, I suppose, is showing you is an important couple of things. Last traded, the current dividend yield on that particular ETF, and then just this is as of today, the up or down change in that particular holding. So the A200 is just the Aussie Beta Shares Aussie 200. It's a broad-based ETF to get us broad market exposure. It's heavily weighted, though, to the top 10 or 15 stocks in the Australian market, or on the ASX 200, which would be your banks and BHP and Rio and probably QBE and some of the financials. So it's mostly weighted to financials and the big mining conglomerates. Nevertheless, gives us that broad-based exposure to Australia and a decent dividend yield as well. Fuel is an energy ETF, as the name would imply. It's also a Beta Shares ETF, and it is the sort of equivalent of the XLE, but on the Australian exchange. It's not as good as the XLE. I find that it doesn't move around as much, probably because of the currency factor. But nevertheless, it has that broad-based exposure to the global energy market, probably constructed a little bit differently and again doesn't move quite as much, probably not as volatile, I suppose, as the XLE. But in any case, that's in Australian dollars. It's on the Australian exchange. That's why I use it. Excuse me. That's why I will use it for the energy stuff. GDX is the gold miners ETF on the Australian exchange. I also own a little bit of GDX in the US in US dollars. So this is effectively an Australian dollar hedged position, but exposure to gold miners. And then the GDX over here is exactly the same ETF, but just on the US stock exchange. Why do I own it on both exchanges? Because you're going to get a little bit of a different price movement in them depending upon what the price of gold does. As far as I'm aware, they're constructed exactly the same. But again, it's just if I want some additional gold mining exposure and I have more Australian dollars and fewer US dollars in the account, I might buy GDX here versus buying GDX on the US exchange. So anyway, Hack is a cybersecurity ETF. It's been a really great performer actually, and it's I think cybersecurity going forward is going to continue to be one of these industries that does very well, particularly in this digital age as we continue to move down the digital path in computing and protecting data and all of that. So that'll probably continue to be a core holding, although it is effectively a technology holding. So if we drop back into a Quad 4 environment, a lot of this stuff will get jettisoned in pretty short order, and we'll move to a very defensive posture. But in any case, that's what that is, and it's done quite well. HUER is the BetaShares Europe ETF, and IUE is the iShares Europe ETF. Now, these two ETFs are constructed slightly differently, and so I wanted to get a little bit of a broad ETF, a broad Europe exposure. I also like the dividend yield on the BetaShares ETF. Mind you, that dividend comes it won't be paid till December and June, so twice a year, but it does have a good dividend yield coming out of it. The IEU probably has a bit more capital growth potential in it. So anyway, that's and the way they invest in countries in Europe is slightly different. So I wanted to make sure I had good exposures to Germany, France, the UK, other European economies like, even Italy. So anyway, those are two ETFs there for Europe, and I've chosen to do that on the Australian exchange because they're hedged, and we have quite a few Aussie dollars sitting in accounts right now, so that was the best way to play that. The IHHY is a global high yield bond fund, and global high yield does pretty well in quads 1, 2, and sometimes in 3. It will do well in 3 if the rest of the bond complex is cooperating. But anyway, I bought that recently, and I think if we're pivoting back into quad 2, the high yield spreads have indicated that there's not going to be a problem. Typically, and this is a metric that we look at for the global macro stuff, if high yield spreads blow out, there's big problems in corporate in these high yield corporates, and it spells imminent trouble in the markets. So the high yield spreads have been pretty benign, haven't moved or beyond a level which is 500 over that we sort of want to be very careful about. So anyway, we'll see how that goes. I might jettison that if it starts to look a bit funny, but so far so good. Pretty decent dividend yield on that as well, and we've got 4 payments per year. So anyway, the Nasdaq is the BetaShares Nasdaq 100. It's just tech exposure. The alternative for me is to buy the Qs in QQQ on the U.S. Stock Exchange. I just haven't had enough capital in U.S. dollars, and I didn't want to have capital converted to USD because the exchange rate's been so bad. So I've just opted to buy the NDQ. It's unhedged, but again, decent dividend yield, and it's done all right. Tech does really well in Quad 2. It actually does really well in Quad 3 as well. So tech is definitely a place to sort of hide out, but it should come back nicely if we do end up pivoting back to Quad 2. Quality is simply it's BetaShares again. This is where, and I pivoted into quality because it's a factor exposure, which means that it has certain attributes. If if things are happening, for example, we go into quad 3, quality is one of the factor exposures that you want to own. So what you'll find in an ETF like that are the big mega cap tech and other mega cap companies that have reasonably low betas but are still going to grow in a potentially benign economic environment. So it's kind of a defensive play. It's done really well to preserve capital, has a decent dividend yield as well. But again, if we get back full on into quad 2, I will sell that position and probably buy back the Russell and small cap exposure, because small caps in value do exceptionally well in quad 2. So that'll just be one of those pivots that'll get made in the portfolio. RBTZ is the robotics robotics ETF, and I just bought this and added to it during a little bit of the market meltdown that we had about a month ago, because long term, the world is headed towards more automation and more use of robotics. And that ETF, again, has recovered nicely and done very well. Its dividend yield isn't too bad either. So it's also got a good broad base of companies globally. So it's just one of those holdings that I'm kind of paying attention to. I'm curious to see how it behaves in quad 2. It did okay in quad 2. It sold off. I bought some more, added to it. And it's done well actually in this quad 3 environment. So I'm just watching that to see, but so far so good on that one. The VAP is the Vanguard Australian Property ETF, and again, I've kind of pivoted into this ETF as a defensive play, because in quad 3, the real estate investment trusts or REITs tend to do pretty well. So again, that was probably a defensive play. Property is not a bad place to be in quad 2 either. However, interest rates may creep up a little bit in quad 2, so that'll just be something to watch. But for now, it's holding its own. It's moved up a little bit. I've got another real estate ETF on the U.S. side, which I'll touch on in a moment, and actually a single holding in basically what is a specialized REIT on the U.S. side. VDBA is a balanced fund. So Vanguard has a number of balanced ETFs that are, I talk about the balanced growth, high growth, conservative, etc. type of exposures, and Vanguard has all of those types of ETFs. And inside of that ETF is the 70-30 or 60-40 or 65-35 type setup, where you've got fixed income as well as stock exposure. So I've begun to use some of those ETFs to get diversification, to lower the beta, and to lower the volatility of the portfolio. And as you can see, get a cracking dividend yield coming through. So again, that pays 4 times a year. We got one coming up at the end of September. If I hold it that long, which I think I will, this may end up being quite a core holding through quads 1, 2, or 3. I may pivot out of the VDBA and into the Vanguard high growth or growth ETF. We'll see. But anyway, it's got a great yield as well as potential for capital growth, which I think it's up marginally, but again, the dividend payment is what will be very handy for something like that. V Bond is the Vanguard Global Bond ETF, and this is and it's hedged, and this is not the like a high yield fund. This is just more of a diversified bond fund, pretty much dwelling in the top tier credits. So your sovereign credits, your semi-government type credits, really big corporates like say an Amazon or something like that. If they issue bonds, they probably do, or commercial paper. And again, good yield, pretty stable. It won't have a high volatility. The beta will be quite low, which is what we want. And again, it's more of a defensive type ETF right now because of the quad 3 situation. You have to pivot to capital preservation, capital protection, and to get some sort of yield capture as well. So that's what that's all about. VIF is the Vanguard. I think it's Vanguard International Fixed Income, if it would come up. Why isn't it? There we go. International Fixed Income Index hedged. I think the credit quality in this is a little bit further down, but not, it's not dwelling in junk or anything like that. It's more of probably a B, triple B, single A. It'll have some other top credits, but probably be more weighted in the middle of the of the credit band, which is why the yield would be a little bit higher. But again, this is kind of a defensive play as well, and it's international, so you get global exposure, etc. So quite a bit of fixed income there, as you can see, sitting in the portfolio. There's two more fixed income. So that's Australia. That's Australia, and there's quite a bit of asset currently sitting in this Australia side of the portfolio. Two more fixed income funds. Again, one of the reasons, and I'll just pause here for a second to just tell you, one of the reasons why you get a lot of fixed income in a portfolio is because fixed income has a completely different volatility profile and beta profile. So for those of you who don't know what beta is, it's basically if the market has a beta of 1, because the market moves up or down, if the market has a beta of 1, some stocks have higher betas, which means that if the market goes up 1%, if a stock has a beta of 2, it means that stock could go up 2%. Or double what the market did, or even more for that matter. And likewise, if the market drops 1% and it has a beta of 2, it means it could drop 2% or potentially more. So the idea is that when you get into an environment where volatility could be rising, which it hasn't, of course, we've observed that, and you need to protect your capital, you want to be in low beta and low volatility type instruments. And bonds typically are low volatility. Depends on where you are. Of course, if you're in the junk bond space, then no, you'll get a lot of volatility. But if you're in the government and semi-government and really big corporate bond space, those aren't going to move around a lot. In fact, if anything, what will happen is people will run into that stuff because they want to know that they're going to get their capital back. And so the bond, you'll actually make money. You'll see those bond funds going up because the bond prices have gone up. The yield obviously will fall if that happens. Anyway, LQD is very similar to this VIF in that it's the investment grade credit ETF. Now this is US ETF, and then MUB is the municipal bond ETF. Now again, these two, particularly the muni bond ETF, their yields aren't great, but again, we had a lot of USD, so I wanted to just buy something that was going to, again, be low beta, provide a yield, and preserve capital. So likely once it's clear that we're going to be making this quad 2 pivot again, those two things will get sold. Pardon me. Okay, let's jump into more of the U.S. holdings now. In this middle column here, these are mostly, there are a few ETFs here, but mostly these are, it's probably 50-50 actually. These are individual holdings. So AAPL, you should all recognize that one. That's Apple. That's a big cap, like, I don't know, market cap of Apple now is over $1 trillion, I think. So anyway, that would be one of those stocks. It's probably, I'm pretty sure QLTY holds Apple and Facebook, but Apple and Facebook, which is FB, are two of those mega cap stocks that have quality attributes that you want to own in an environment where you're in quad 3. And they've both done pretty well in this environment. They've continued to move up. And look, for all intents and purposes, probably through quad 2, I'll continue to own those as well. But they give some nice stability to the portfolio and lower betas, and the vol hopefully won't be too bad. I mean, both of these companies are massive now. Facebook is provided, of course, I suppose the governments don't start to hammer them on taxes and things like that, or whatever it is they're doing. There's something going on, I think, in the U.S. right now around some court cases, or maybe it could be Europe, for Apple and Google. And I think Facebook is in a bit of strife with the Department of Justice over something. But anyway, I'm sure they'll prevail in some shape or form. Certainly, it's not going to be, Facebook's not going to go away tomorrow, right? So anyway, Coin is a bit of a play on the cryptocurrency market. So one of the things I've been trying to do is figure out a way to play cryptocurrencies, because in quads 1, 2, and 3, cryptos typically do very well. Now that's not all cryptos. Like, I don't know how many cryptocurrencies there are. The last time I did a check, there was something like over 3,000 of them. I'm sure there's probably over more than 4,000 now. People seem to think that you've just create a cryptocurrency and put it out there, you're going to become a billionaire overnight somehow. So I'm not interested in any of that. I'm interested in playing with the key coins like Ethereum and Bitcoin. And there's a couple of ETFs that are trust. Now I'm trading these and owning these in my personal account, my PA, just to see how they sort of go. But certainly one of the things I'll be potentially looking to do is to play that crypto space in that way. And I'll talk more about it down the track when it comes to fruition. But in the interim, Coin is Coinbase. So it's one of the larger exchanges for cryptos, and it's just like back in the gold rush back in the 1800s in California. The guys or the people, I should say, that sold picks and shovels to the gold miners and the speculators made more money during the that whole period than many speculators did. In fact, a lot of speculators went broke, but the people that sold picks and shovels, they hung around. And Coinbase, I view it a bit like that. It is currently a stock that because it's just floated, it's got obviously a lot of attention. But again, I think because of that attribute of being a pick and shovel type stock, it'll be around even if the cryptocurrency market falls a little bit. You won't see that necessarily translate into Coinbase. Again, I'm watching it. It's something that I'm prepared to let go of fairly quickly. But in quad 1, 2, and even 3, the cryptos will traditionally do fine, and so something like Coinbase will be fine. I've already touched on Facebook. FCX is the Freeport-McMoRan. Freeport-McMoRan is one of the largest copper miners in the world. Copper, as you know, is a commodity, and when you have an inflationary environment where the US dollar is falling, you want to own inflation assets, and copper is one of those. Copper has the added benefit, of course, of being an industrial metal and something that is going to be required heavily in the electrification of everything, of course, and in the infrastructure build-outs that are going all over the world. So for now, anyway, as the U.S. dollar continues to fall, a stock like Freeport will continue to do well. We've owned this off and on. I've traded in and out of it, taken profits from it many times. So it's been a good holding over the last 6-9 months or so. I've already talked about gold. MSOS, unfortunately, this one's been a bit of a dog. So many of you know, because you've been clients for this amount of time, is I was a bit of a cannabis bug probably about 5 years ago. And unfortunately, I didn't have the same full cycle investing process that I have now 5 years ago. Had I had that, I wouldn't have been in the cannabis space. I would have hopefully gotten in, ridden it to the top, and gotten out. And unfortunately, there's still a couple of legacy cannabis positions that are underwater. They're floating around. Anyway, is what it is. The cannabis industry is pretty much all small cap based. So right now, Quad 3 is not a small cap quad, and an ETF like MSOS has been pounded, and the small caps cannabis stocks have been pounded. So, there's a great story around cannabis, and as you know, I don't like to get sucked into the story side of this stuff. I want to be more of a maths focused and quad focused person. And right now, unfortunately, now's not the time to own MSOS. I've just left it there because I've left it there. So anyway, it'll come back at some point as cannabis continues to develop as an industry. The legislative barriers come down. Well, I should say the legal barriers to growing it, owning it, distributing it, etc., all come down, and I think that's underway. So that's kind of a longer term play, which is why I've just let it sit there instead of taking the loss on it at this stage. Now this is interesting. Playboy. So I think I've mentioned this a few times. Playboy was had a massive restructure. So of course Hugh Hefner died, I think about, I don't know, it's probably 8 or 9 years ago now, and the company for the longest time has never really made a lot of money off of the fact that it is one of the most recognizable brands on the planet. I think it's in the top 3. I think Coke, Virgin, and it might be GE or something like that are one of the top brands recognizable. Oh, sorry, Nike. Sorry, not GE. Nike would be one of the top 3. But Playboy is up there. It's either in the top 3 or top 5. I forget. And anyway, it went through a bit of a restructure. And the management team that's there now is cracker hot. Like, these guys and gals are fantastic. And they want to grow this business into a multi-billion dollar company. I think the market cap of Playboy at the moment is something like 3 or 4 billion, somewhere in that range. But we're talking about this company growing to be a 30 to 40 billion, potential billion dollar global conglomerate. They made an acquisition in Australia a couple of months ago of Honey Birdette, which is a lingerie sort of I don't know what you'd call it, but in that space. And so they're on the acquisition track. They are getting a a lot of their IP and these new things called non-fungible tokens are in that space. They're just killing it. They're doing a lot of partnerships with other clothing lines to license their obviously the Playboy Bunny. So hugely good things coming down the pike. That'll probably be a long-term portfolio holding. Unfortunately, it's had a little bit of issue in the last couple of months because it's technically still a small cap. So it's not a factor exposure that you want to have on during quad 3 or a quad 4. But as long as we stay out of quad 4, and we pivot back into quad 2 or quad 1, that little guy is going to rip. And I think it'll be a long-term holding. I wouldn't be surprised in 3 to 5 years if that ends up being $100 to $300 stock. So I'm not at this stage. Do I have any designs on flicking it? And I may add to the position if we get another little sell-off for some reason. But anyway, it's at the moment it's slightly underwater, but I'm not worried for all the reasons I've just articulated. PSA is a REIT, and they focus on public storage, which for whatever reason is quite hot at the moment. Decent dividend yield. Again, it's a REIT. I've kind of gone through the reason that we own the real estate investment trust at the moment. But other than that, it's just a great company anyway. Not that I'm a story guy, but again, there are some things that you certainly want to own in quad 3. Real estate investment trusts are one of them. You can continue owning them in quad 2. So I'll just have to see what happens if we pivot out and play it accordingly. SBUX is Starbucks. Again, this is one of those mega cap global companies that you sort of hide out in when you look at their quality factor, again, that you hide out in if things are looking a bit dicey. It's underperformed a little bit, which is disappointing, but look, I'm just going to see how it trades. I suspect that as the economy's reopened, they will continue to do better, and the price of coffee, I think, has been a little bit elevated too, so who knows, that could be impacting some margins, but again, I'm not worried about it, and it's just going to sit there. It does have a lower beta as well. XLI is the industrial sector ETF. I had sold it anticipating the quad 3 pivot, but I've just recently bought it back because, again, we're looking as though we may very well be pivoting back into quad 2, so I've taken an initial small position there. It does have a reasonably okay dividend yield, and again, as the economy reopens and continues to reopen, a lot of these big industrials are going to continue to do well. XLRE is a real estate investment trust, again, a REIT, and it holds a lot of different companies. PSA is one of the companies that XLRE holds. Again, this is that macro position, as is XLI. Anything with an X in front of it here is a macro position, and they own the broad base of that particular industry. So that's real estate, that's the industrials in the U.S. and some globally. XLU is utilities. Now, utilities is an interesting one. Utilities is one of the places where, again, you hide out in something like a quad 3 environment. If we're going to be pivoting back to quad 2, this will be gone. And in fact, I sold, I think, about 10 or 15%, maybe 20. It might have been half of that position overnight because it's at a new all-time high. And again, I wanted to take some profit off the table, again, in anticipation of possibly a quad 2 pivot. And by the way, there is absolutely nothing wrong with taking profits as you go along. In fact, a full cycle investor should be doing that. As things go up, selling incrementally to then possibly buy it back when we get a sell-off, as you've probably seen me doing, is absolutely the smart way to invest. And I'll tell you right now, it's exactly what a lot of fund managers are doing. You just don't see that, of course, because you don't get this kind of view and a look in to see exactly how a fund manager would manage the assets underlying it. But I'm telling you right now, a fund manager would be doing the same thing. And the way that I can prove that to you, I won't bother showing you, but I'll tell you where to look this up. There's this thing, if you look at a sheet on a fund, any fund, pick a fund, probably an equity fund would be best. There's this metric called portfolio turnover, and it's usually represented as a percent. And pretty much if you see anything above 50%, it means that they're actively trading that portfolio, because it means the portfolio is turning over, 50% of the portfolio is turning over during the course of that reporting period. I think it's over a year's period of time. So the higher you see that number, the more that fund is trading. So when you see that metric, when you see that, look for turnover, portfolio turnover. If it's more than even 30 or 40%, it just means that they're actively trading the fund. just a little FYI there. Okay, so next thing, consumer discretionary. I've just kind of held on to this. Consumer discretionary is one of those asset classes or sectors that does really well during a quad 2 or even quad 1 economic expansion, because of course in those periods people have more money, there's more discretionary income, and of course there's going to be more discretionary spending. So the discretionary consumer discretionary ETF does well in that environment. If we were to enter a really nasty quad 3 or possibly even a quad 4, probably not even in quad 4, I would own things like the consumer staples, because those are, that ETF would be loaded up with things like, grocery stores and just things that people have to have, right? So that's why they're called consumer staples. That's why this is called consumer discretionary, because they have discretion. In any case, that's done all right, and we'll just continue to sit on that as well. The XLK is the technology sector ETF. Now, again, I mentioned tech over here. We've got the NASDAQ. This is probably the brother, the partner over in the US dollar. The only thing that's a little bit problematic about this ETF is that the top 2 holdings in it represent a large portion of the fund, and if they have a hiccup of any sort, then the fund can have problems. But at this stage anyway, tech is a quad 3 holding as well as quad 2, and so we just sit tight on that. A couple more things and then I'll wrap it up. Norway and Germany. So here are 2 country-specific ETFs that I wanted to own outside of the broader Europe exposure that I mentioned earlier. Germany is absolutely ripping at the moment. It's the manufacturing powerhouse of Europe, and Germany's doing very well. Norway is a play on oil. So the Norwegian economy is heavily focused around the oil economy, and so as oil is a quad 3 and quad 2, or energy is rather a quad 3 and quad 2 asset exposure, well, Norway makes a lot of sense. Plus, it has the added benefit of being in Europe, and Europe is actually in quad 2, and the European quads are looking quite good going forward. So a few other reasons to tick that box to own that stuff. I'd also like to buy Switzerland and a few others. I've got some buy orders in there for those. We'll see if those click over or not, but in any case, I may have missed the boat on that. But anyway, as I say, we've got this broad Europe exposure here, so I'm happy with that. Now, the third column here is all energy. So I think it's all energy. Yes, it is. So just quickly to go through this, all of these companies are in the XLE. Now, XOM is actually ExxonMobil, so that's not an ETF. That is a specific company. But XLE right there is the energy ETF, which has all of these guys in it. And I'll just quickly run through it. So this is actually an ETF, which is the Alerian MLP, which is basically oil investment trusts and things like that, like partnerships where you have transmission lines, like your gas, your oil transmission lines, all the infrastructure. It owns a lot of infrastructure, but it pays a really good dividend, as you can see. But of course, it will float up and down depending upon the price of oil and what's going on in the oil market, and to lesser effect, natural gas. It's a little bit underwater at the moment, as are a few of these positions. So we've had a correction in oil. The companies have been a bit latent to come back, even though oil's trading around $70 a barrel again. I think if we get a spike of oil up into the $75 to $80 range, all of these companies are going to absolutely rip. So again, it's a quad 3 and quad 2 asset. So we're in good shape right here because it's an inflation asset. So we're still in good shape. I'm not going to panic or do anything stupid here with the oil portfolio, except sit on it and maybe add to it. Unlikely. I'm pretty happy with the level of positioning at the moment. Anyway, ConocoPhillips, I'll just hit the companies. Chevron, that's Diamond Energy. Halliburton, Hess Corp, Marathon Oil, Occidental, Phillips Petroleum. This is actually an ETF, RSX, the Russian ETF. Again, that's a country-specific ETF, clearly, that Russia's economy is heavily exposed to the energy economy, and it has been on a tear. It's actually done really well, the Russia ETF. I've been very happy with that. Schlumberger, I've already talked about XLE and ExxonMobil. So all of that's your energy exposure. And again, as you can see, all of these companies pay dividends as well. In fact, a lot of these companies pay dividends. So as you can see from this portfolio, there's good income level coming in. So you'll see the dividend. If you look at any of your reporting, you'll see dividend income coming in on a quarterly basis, which is a big thumbs up. And of course, we're trying to squeeze out as much capital growth out of this thing as we can by being in the right sectors for the quad that we're in. And that's what I'm aiming to do. So there's your position update. How'd I do on time? 34 minutes. Wow, that was a long one. Anyway, guys, thanks for sticking through that. If you do have any questions about any of the positions, please let me know. I hope you find these position updates useful. If you do, let me know. It'd be great to get some feedback from you if you do find them useful. And if there's anything specifically that you'd like me to talk about, if you could put those in the comments in the boardroom, that would be great, because then other people can see what you're thinking as well and maybe feed off of that. And if you have any questions about something you'd like me to specifically cover on a company, please let me know as well. Because again, if you have that question, there's a high degree of likelihood that someone else in the community will have that question. Enjoy your weekend, and I'll talk to you soon.